Welcome back to Smart Money and Wealth. Today is Wednesday, June 10th, 2026, and the global markets are facing a dual threat. Geopolitical escalations in the Middle East have triggered a sharp spike in crude oil, while a heavy pullback in the semiconductor sector is dragging major U.S. indices down. If you're managing a portfolio, today's events demand your immediate attention. Our top story: geopolitical risk has returned with a vengeance. Overnight, reports surfaced of military strikes between U.S. and Iranian forces following the downing of a U.S. military helicopter near the critical Strait of Hormuz, the world's most crucial oil transit choke point. The immediate market response was classic risk-off. Brent and WTI crude surged by over 4.5% within hours, stoking fears of supply disruptions and reigniting the inflation trade that has plagued global economies This geopolitical shock triggered immediate panic in equity markets. We are seeing back-to-back declines in the S&P 500, while Nasdaq futures are leading the sell-off. But the pain isn't just geopolitical. The technology sector, especially artificial intelligence and semiconductor giants, is experiencing a massive liquidity withdrawal. After months of parabolic growth, traders are taking profits, lock, stock, and barrel, using the geopolitical escalation as the perfect trigger to de-risk. As equities bled, safe haven assets caught a massive bid. Gold surged back toward its all-time highs, and the US dollar index, DXY, climbed to 105.8, indicating strong cash hoarding. When the dollar strengthens and oil rises, it exerts massive pressure on emerging markets and tech stocks. In this environment, capital is flowing away from risk and toward liquidity and hard assets. In a moment, we'll look at the shocking CPI data released today, which makes this market setup even more dangerous.
That brings us to the second major catalyst of the day, the release of the May Consumer Price Index, or CPI. Inflation accelerated to 4.2% year over year. While this matched the consensus expectations of economists, it represents the fastest annual pace of inflation in over 3 years. For months, the market has played a game of wishful thinking, hoping that inflation would naturally glide down to the Federal Reserve's 2% target. Today's report officially kills that narrative. If we look under the hood of the CPI report, the details are even more concerning. Core CPI, which excludes volatile food and energy costs, is sticky, driven by persistent shelter costs and skyrocketing service inflation. When services inflation remains this high, it means inflation is structural, not transitory. And now, with the Strait of Hormuz crisis pushing oil prices up, energy inflation will spill into next month's data, suggesting that we haven't even seen the peak of this wave yet. What does this mean for everyday finance? It means the purchasing power of raw cash is eroding at an accelerating rate. At 4.2% inflation, a cash-heavy portfolio is losing nearly 5% of its value annually in real terms. More importantly, it squeezes corporate profit margins. Companies are finding it harder to pass rising raw material and wage costs down to consumers, who are already stretched thin by high interest rates. This is the classic stagflationary squeeze. Even though the headline figure didn't beat expectations, the fact that it is holding at a 3-year high of 4.2% sent bond yields climbing. The 10-year Treasury yield jumped to 4.65%, making fixed income more attractive relative to high multiple tech stocks. This yield spike is the primary driver behind today's stock market pullback. It is clear that the bond market is pricing in a much tighter economic reality. And that brings us to the most critical event on the horizon, next week's FOMC meeting.
Next week, on June 16 and 17, the Federal Open Market Committee will gather for one of the most highly anticipated meetings in years. This will be the first policy meeting led by the newly appointed Fed Chair, Kevin Warsh. Warsh enters the role at a chaotic moment. Inflation is stuck at 4.2%. Geopolitics are threatening energy prices, and the market is desperate for direction. The era of predictable, dovish guidance is officially over. For the past year, Wall Street has debated when and by how much the Fed would cut rates. Today, the conversation has completely flipped. Fed funds futures are now pricing in a growing probability of another rate hike by the end of 2026. At next week's meeting, all eyes will be on the updated dot plot, the chart showing where Fed officials expect interest rates to be. If the dots shift higher, it will confirm the Fed's willingness to push the economy into a slowdown to break inflation's back. Kevin Warsh has historically been critical of the Fed's heavy reliance on forward guidance, the practice of telling the market what the Fed will do months in advance. Analysts believe Warsh may begin dismantling this forward guidance, shifting the Fed toward a much more reactive, data-dependent stance. For investors, this means volatility will increase. We will no longer have a Fed that promises to bail out the stock market at the first sign of trouble. The Fed is trapped in a classic monetary corner. If they cut rates to support the slowing economy, inflation risks spiraling out of control, fueled by high oil prices. If they hike rates to combat 4.2% inflation, they risk triggering a credit event in the banking sector and increasing the U.S. government's debt servicing costs. How Warsh navigates this tightrope next week will define the market's trajectory for the rest of the year. Make sure you are subscribed to the channel because we will cover his press conference live.
Now, let's pivot to the digital asset market, which is experiencing its own trial by fire. Bitcoin has suffered a sharp sell-off, dropping to the critical support level of $61,000. As traditional equities de-risk due to the Strait of Hormuz conflict, crypto is once again acting as a high beta risk asset rather than a safe haven. Speculative leverage is being flushed out, and the pain is widespread across altcoins. This aggressive price drop has sent market sentiment into an absolute tailspin. The Crypto Fear and Greed Index has plunged to $9 out of 100, entering deep extreme fear territory. Historically, a reading single-digit index score indicates peak panic, where retail investors capitulate and sell at a loss. But for smart money, extreme fear has historically represented one of the most lucrative times to accumulate premium assets at a discount. Adding to the bearish pressure, we are witnessing consistent net outflows from Bitcoin spot ETFs. Institutional investors who flooded into BTC ETFs earlier in the year are temporarily pulling back to hoard cash and short-term bonds. This institutional outflow removes a major buy wall, leaving Bitcoin vulnerable to liquidations. However, on-chain data shows that long-term holders, the strong hands, are not selling. They are holding firm, while the short-term speculators are the ones fleeing. Despite the short-term price panic, the structural foundation of the digital asset space continues to strengthen. We are seeing accelerated adoption in the tokenization of real-world assets, or RWAs, such as tokenized treasury bills and real estate. Major global financial institutions are continuing to build digital infrastructure, ignoring the daily price noise. The key is separating short-term price volatility from long-term technological adoption. Now, let's put all of this together and map out our actionable trading and wealth plan.
Let's build our action plan. First, for tech and equity investors, do not panic sell into this pullback. If we look at the charts, the Nasdaq's Relative Strength Index, or RSI, is rapidly approaching oversold territory. Key tech leaders are fast approaching their 200-day moving averages. This is where big institutions place their buy orders. We are looking to systematically buy the dip in high-quality semiconductor and AI infrastructure stocks, but only at established support levels. Patience is key. Second, let's talk asset allocation. In a 4.2% inflation environment with rising geopolitical risk, you must adapt. A stagflation-resilient portfolio should reduce exposure to highly speculative, unprofitable growth companies. Instead, tilt your portfolio toward cash-flowing value stocks, energy ETFs to capture the oil surge, and short-term treasuries that yield over 5% risk-free. Gold remains your primary shield against geopolitical risk and fiat currency debasement. For cryptocurrency, with the Fear and Greed Index at 9, the math says this is an accumulation zone, not a selling zone. Rather than going all in, the smart money strategy is to employ a strict dollar-cost average (DCA) schedule. By buying Bitcoin in structured tranches at $61,000, $60,000, and potentially $58,000, you lower your average cost basis while letting the market flush out the final speculators.
Maintain a multi-year horizon. We are navigating one of the most complex market setups in recent history. The CPI inflation shock, geopolitical escalations, and the upcoming Kevin Warsh FOMC meeting will create massive opportunities for prepared investors. Don't let fear dictate your financial future. Subscribe to Smart Money and Wealth, turn on notifications, and let's navigate this market cycle together. Let us know in the comments, are you buying this dip or holding cash? Stay smart, and we'll see you in the next briefing.